Hey traders, this is Ron Haidt at Market Tamer. I hope you guys are having a fantastic weekend. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk and specific financial issues shall always be addressed with your financial advisor. We'll kick off here with the SPY. Finished down just a little bit on Friday. You can see we have opposing candles here, opposing tails, if you will. We had a gap up to all-time highs on Thursday. We pulled back, then closed near the highs. Friday, we got above them and then closed slightly lower. This can be an indication it's a two-day candle pattern of a potential high. But you know what? We could easily just open up and go higher tomorrow and it erases that. So what I like to do here is still use the 20-day EMA in red as a trailing stop. And this is a daily chart. Even if we had a open on Monday and close lower, this isn't a weekly candle. It's not a monthly candle. They're just daily. So it would just be a short-term thing. However, if we get below the red line, that could be a warning sign, and it would be a warning sign for me that, you know what, maybe this little, push higher and then come right back down. This is a bit of an exhaustion move, and we might have a bit of a trading range now potentially for the summer. Because typically the S&P does go nowhere over the summer between now and October. It's literally 50-50 chance of less than a 0.5% move net. So if history seasonality lives up to its expectation, there's no big move. However, we could have world events, we could have policy changes, the Fed, there's all sorts of things that could potentially be a catalyst. But right now, walking into this week, the bulls have the edge despite of these opposing candles, and we stay above the red line, bulls would retain that edge. Even, again, if we came down even Monday, Tuesday, Wednesday, Thursday, Friday, we could have 5 red days, but we stay above that red line. That's going to be the key. That's going to be the litmus test. How about the diamonds? Similar situation, gapped up to new all-time highs in the DIA. We got above them on Friday, and we finished a little lower on the day. Same story here. If we look at the Qs, now they are not at all-time highs. However, they did have a really nice day on Thursday, and then Friday it pulled back a little bit. Again, as long as it stays above the red line, bulls have the edge. The diamonds and the spiders are still performing the best. Now, Russell 2000, Indigo Whiskey Mike. Yep, it's still lagging. Despite the market having a really good day on Thursday, it moved up a little bit and it gave it all back on Friday. This lag is really interesting. Normally this would be, and it is, a negative divergence in the market, bearish divergence, but it's really not having much impact on the Dow and the spiders. So I would trade this one almost separately. The trend is your friend in the Dow and the S&P. On the IWM, so here was a high that barely took out these other highs right in here. So this was a higher inner swing low, swing highs. This is a higher inner high, okay? Then we get another higher inner high, but we still haven't taken out this main high. Well, guess what? Now we've gone to a lower high, and here is a lower low than here. If I start drawing this, you sort of get the idea. We're in a bit of a downtrending channel. It's not major, it's not massive, but it is present. So if I had to pick a strategy, I think a bear call strategy here on the IWM, despite the overall market holding up, seems to be maybe the most favored trade idea strategy. All right, look at the MDY, mid caps. Is there any difference here? Again, you go back in February, we took out these swing highs in here. We got a higher swing high, could not take out the all-time highs, and now we have, as of Friday, a lower swing high, and we have lower lows. So it's almost the same story here with MDY. Now, I had a question here, and I want to use Lyft about moving averages. Now, Lyft is new. It's only been open since March for when it went public. And the 50-day in orange is an institutional moving average. Well, that just came in right around June 10th. And the 20-day EMA, you can see, is here, right? I like to use the red line as a potential trailing stop. Nothing's ever perfect, but sort of works more than it doesn't. So here we get below, here we're above, we dip below, get right back above. The question is, what do you do if the EMAs aren't working? Two things. One, I could just draw a trend line. I take the low and you want to connect 3 points. And I sort of can, a point there and a point there. Now, it would even be better if I could connect 3 lows, 3 separate lows. It's not the case. So a trend line is one opportunity. Go to a low and just draw it. You want to connect at least 3 lines. The next thing is to actually use a swing low as the stop. And that would be either an intraday low or a closing low. I prefer closing lows because that's where the money was put down and taken into the next day. And that would be right here on 610. That closing low would be 56.76. So if we were to close below there, that would be the final stop out if I didn't want to use a trend line or an EMA. So I hope you find that helpful. All right, next, let's take a look at a couple healthcare stocks. We keep covering Apple and Google and all that good stuff, and we can do that next week. But healthcare stocks, specifically Humana, had a really nice move on Friday. If we take this back to November, we had this spike high on earnings. Then it started moving lower. We had Bernie Sanders come out and say healthcare for all. Not saying that's good or bad. All I'm saying is healthcare stocks did not like it, and they just kept moving lower. We had a hammer-like candle back on 417. We had a breach above the 50-day. If I zoom in here, about a month ago, and then it rolled right back over. But here's the thing. As this began to surge above the 50-day, volume was at least average, maybe slightly picking up. But on the subsequent downdraft, which sort of brought you right back below these moving averages, volume sort of fell off a little bit. Now, yeah, that was Memorial Day holiday, I get it. But if you look back over the past month in June, the black bars, which are up days, are taller than the red bars, which are down days. That's typically a good sign if you're a bull and you want prices to move higher. And then we get this big surge here on Friday. As of right now, the 200-day moving average, which is an institutional moving average, would be the target. That's 290, 20 bucks higher. So it's not quite 10%, but not bad. If I zoom out, look how the 200-day acted as resistance in February, the beginning and end of February, around 310. If we get above that 200-day, that's a big deal because not only was it resistance here, look back here, support, support, and then when we broke through, resistance, resistance. So for whatever reason, the big money is paying attention to that line, which is not uncommon because it is viewed as an institutional type moving average. If I wanted to trade Humana bullish, what would I consider as a trailing stop? Well, using the lift example, 20-day EMA or the most recent closing swing low, which would be 243.21. UNH, another healthcare stock, look what it's doing. Stuck 2 straight days at its 200-day moving average. Over here, we had one day, it was below it, got back above it, the next day a little below it. Then we had a rally rejection. Then we cut through it like a hot knife through butter and come back and test, hot knife through butter, resistance. Humana is a better example, but United Health isn't that far off either. The 200-day seems to be a big deal. We zoom in here. Volume on Friday was good. We closed above the 200-day. What would be the target? You go right back up to the most recent reversal, which is around 270, and it actually acts as arguably even a triple quad top, but there's basically 2 humps like a camel. So the 270 is the target, and then you'd go back up here. All right, how about a different stock? I was looking for stuff to trade or just to look at from something we haven't looked at in a while, is what I'm trying to say. This is VSAT, VSAT, not that heavily traded, less than 800,000 shares, but look what it did. It closed near the lows of the day, volume picked up. The next target, gap fill, arguably 72.50, 11 bucks lower. There's no pause until we get all the way down there, and then the gap fill down to $65. This is a great example of a trend change. Here was an earnings move. Let me zoom in. Earnings gap up, we pull back to the 50-day and we bounce. That's fine. In fact, I could even consider a long position at this point if I wanted to. Then on the 11th, we pull back, we hit it, then we get below it, and notice what we can't get back above. The orange or the red. Orange is the 50-day SMA, the other institutional moving average, and your 20-day is a short-term trend line, and then we just fall off. So if I was a bull, I would have been stopped out on the 13th, 14th, 17th. I'm out, and you actually would have sidestepped this move down. But at this point, downside targets are pretty significant. How about MO? This one can't get out of its own way. Altria down big on Friday. It sort of took out these lows. I would call it a clean break. Volume picked up. There's a little bit of support around 47.50, but then it's back down to the January lows at 42.50. I keep getting questions on KHC, which is Kraft Heinz. Really no change yet. I am keeping an eye on this one. There's all this 32.50 resistance. I can't tell you why that 32.50 was a magnet, but someone was selling when we seemingly get up there. It is above the 50-day as of Friday. Hey, that's a good sign. 12 million shares sound like a lot, right? But in comparison to since the no, well, frankly, since December, it's not that much. I would have hoped to have seen maybe a spike up into here, so it looks like an oak tree among, the weeds. Just not the case. So is today a positive, or is Friday a positive development? Yes, for the bulls. If I was a bear, I'd be paying very close attention. If we get above 32.50 on a closing basis, then 35 bucks, then the gap fills the target. I mean, we could go to the 200 day, but there's a whole lot of real estate in here that could be rebounded from. So that is it. Bulls have the edge for the week ahead on the SPY and the diamonds, which are, the broad market. Q's lagging a little bit, but they're hanging in there. If we break the red line, the 20-day EMA, that's where the bulls would lose their edge. So have a great week, gang, and I'll see you in the next video. Take good care.